A great place to start when searching for potentially undervalued stocks is to look for negative share price performance, and in this video we'll be talking about 3 stocks who've just been getting the pie beaten out of them and look like prime pickups for your portfolio as we head into July. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. Anyway, getting into the first stock of the day, we are talking about WP Carey, ticker symbol WPC, who's really not seeing a substantial share price drop in the last month. They're only down about 0.6%, but if we look at their year-to-date performance, they're down quite a bit more, nearly 13%. And if we zoom out across the last year, they are down nearly 19%, so pretty big share price drops there. And if we look at the right-hand side of the screen, WP Carey is inching closer and closer to their 52-week low. They are like right there. And the forward P to FFO, which is like the real estate investment trust equivalent of the PE ratio, is not looking too bad either, 13.2. It's not too high, it's not too low. Anyway, moving on and looking at the dividend stats, WP Carey is a pretty high-yielding real estate investment trust with a forward yield of 6.2%, and they have a decently high payout ratio, I will admit, near 82%, and Seeking Alpha actually recently updated their website to now show the FFO payout ratio for real estate investment trusts. When you were looking at something like Realty Income or WP Carey or VG Properties or any real estate investment trust, it would often show a payout ratio over 100%, which, as I'm sure you can imagine, is cause for concern for many investors looking at this. So making the switch to the FFO payout ratio for real estate investment trusts is a welcome move on the website. I'm glad to see that, and I think that will make things a lot less confusing moving forward. But anyway, back to WP Carey. Looking at the 5-year growth rate, there's really not much to speak of here. It's just above 1%, which I guess is the trade-off considering they do have a high starting yield, so you can't have your cake and eat it too. And WP Carey does have a pretty respectable dividend growth history of 9 straight years. And looking at the dividend history chart, if we go all the way back, it actually looks like WP Carey has been growing their dividend for longer than 9 years, and there was some really aggressive growth right here after the great financial crisis. But even before then, it looks like they had some dividend growth going. And I actually have some WP Carey in my portfolio. As you can see, I have just over 22 shares at an average cost just below $70 per share. So I'm down a little bit. If we keep scrolling to the right, we can see right here that I'm down about 2.25%. So really nothing too bad. And I think this would be a good REIT to consider swooping up some more shares of or adding to your portfolio if you don't already have it. WP Carey is one of the world's largest net lease landlords with nearly 1,500 different properties located all across the globe. And their diversification to different sectors and locations helps them mitigate risk, as does their consistently high occupancy rate. Anyway, moving on to the second stock of the day, this one is Humana, who dropped as a result of negative earnings expectations by one of their peers, United Health Group, ticker symbol UNH, at a recent investor event. During the event, UNH projected that its expenses for medical services would be increasing because more seniors are seeking outpatient medical services, and so a larger portion of the premiums paid by their customers would be used to cover these additional healthcare costs. As a result, UNH's stock price took a dip on the news, obviously, and it also appears to have affected Humana as well. Looking at Humana's share price, they saw a really big drop in the last month. They are down 11.75%, and you can see that they really fell off a cliff right here. And then year to date, this brings them to a loss of about 9.5%, and then in the last year, they are actually still up, surprisingly, barely breaking even, up 0.8%. But if we look at the right-hand side of the screen, they are inching closer and closer to their 52-week low, so they're definitely getting down there. And taking a deeper look at their valuation, the forward PE ratio is 15.77, so it's really not too bad, and this is about 18.5% below the company's 5-year average PE ratio. And scrolling down, we're seeing a similar trend with the forward price to cash flow, which is sitting really low, 8.67, and this is 41.5% below the 5-year average, so big discrepancy there. And now taking a look at the dividend stats, admittedly, Humana's not the highest yielding company out there. Their forward yield is actually pretty weak, but the rest of the dividend stats are looking pretty good. The payout ratio is very low, only 12.25%. In fact, the payout ratio is lower than the 5-year dividend growth CAGR, which is sitting near 14%, so they have some nice growth working for them. And they have a decent dividend growth history as well, 6 straight years, which based on the payout ratio, I'm sure they'll have no trouble continuing. Anyway, moving on to the third stock of the day, we are talking about Target. And at this point, I'm sure many of you are familiar with the boycott surrounding Target, and I'm sure there are at least a few of you out there who are standing in solidarity and are no longer buying from the store or investing in the company. With that aside though, for those who are still open to considering it for their portfolios, it's hard to deny that all of this bad press surrounding the company is creating a pretty solid buying opportunity. Looking at Target's share price performance, in the last month they are down about 11.3%, so a very big drop in the last 30 days due to all this bad press. And then if we look at their year-to-date performance, it's about the same, 11.8%, 10%, and then in the last year, they are down roughly 8%. And looking at the right-hand side of the screen there at the 52-week range, Target is getting pretty close to their 52-week low. They are well within 10%, and I would not be surprised if they got there. And then just looking a little bit further into their valuation, the forward PE ratio is about 16, so not too bad, and this is about 14% below the 5-year average. And right now they have a very low price to cash flow, just under 8, and this is about 27% below the company's 5-year average. So once again, quite a big discrepancy there. And you guys know what happens. You know the silver lining when these companies drop big time in share price. It pushes the dividend yield substantially up. And that's certainly the case here with Target. Their forward yield is 3.3%, which is about 41.5 above the company's 5-year average yield. So a much nicer cash flow return with this company by buying right now. And looking at the rest of the dividend stats, the payout ratio is a bit high, 70.5%. And looking at their income statement real quick, the current payout ratio is a bit above the company's average payout ratio, it seems. Usually it hovers between, 40, 50%, somewhere in there, but in recent times it's jumped up to 66 and now 70%. So definitely something to keep an eye on. But anyway, looking at the rest of the stats, the 5-year growth rate's pretty nice, double digits, just under 12%. Do like to see that. And they are a dividend king still with 54 years of growth. And with that, guys, those are the 3 stocks that I really wanted to hone in on, but still, there are so many great stocks out there that look like pretty sweet deals as we head into this upcoming month that I think you need to keep your eye on. The first one is going to be AbbVie, who is down 5.6% in the last month, so a pretty big drop for these guys in the last 30 days, and then year to date, AbbVie is down 15.7%. Wow. Next up is Allstate, which I haven't talked about for a while on this channel, but in the last month, Allstate's down about 8.5%, and then year to date, they are down 21.2% basically, so another big drop for Allstate. Next up, we've got Flowers Foods, who I rarely talk about, but I couldn't resist, guys. They are down 4.2% in the last month, and then year to date, they are down 14%, and looking at the right-hand side of the screen, they are right there at their 52-week low. And then we've got Conagra Brands, who is down about 3% in the last month, so really nothing too crazy, but then year to date, they are down double digits, down nearly 12%. Another one to keep your eye on is UGI, who is down about 5% in the last month, and they've really plummeted in 2023. They are down about 30%, and they are most definitely sitting at a 52-week low. Look at that. And then we mentioned this one earlier a little bit, but United Health Group, keep your eye on these guys. They are only down about 0.5% in the last month, which is surprising considering the news really pushed Humana down, but year to date, United Health Group is down 11.6%, so a pretty decent drop in 2023 so far. Also, British American Tobacco, BTI, is one to keep your eye on. They're pretty flat in the last month, only down about 0.75%, but they've really come down this year. They are down 19.2%, and they are getting pretty dang close to their 52-week low. Next up is CVS, who stayed surprisingly flat in the last 30 days, basically breaking even, but year to date, they are down 26%, and they also are sitting at their 52-week low, so definitely one to keep your eye on. Next up, keep American Tower Corporation in the back of your mind. They are only down about 1% in the last 30 days, but then year to date, they are down about 12%, and also getting pretty close to their 52-week low. And then last but not least, Williams-Sonoma, you got to keep your eye on these guys, even though they have jumped up 8% in the last month, and year to date, they are up 6.67%. I still think the valuation on this one's looking pretty good, and I actually just added Williams-Sonoma to my own portfolio, which I'm telling you all about in this next video right over here. Many of you know I've had my eye on this stock for at least the last couple of months, and I finally pulled the trigger and started a position, which I'm very excited about. So click right over here to check it all out, and I'll see you in the next one.